I want to thank you for joining us today. We're going to talk about the infinite banking concept. Now, the infinite banking concept is something that grabbed my attention and really never let go. I immediately recognized it for the potential to maximize somebody's cash flow and to do it in a way that's extremely safe and helps to provide the maximum returns in these safe vehicles. What the infinite banking concept is it's the use of a specially designed cash value life insurance policy that's designed to be used as a personal bank that you can put money into and take money out of over and over again, knowing that every time you pay into it, all that money will be available to you to take back out of it, just like you were putting money into a checking or a savings account. The big difference is your money is sitting in a life insurance policy that has guaranteed growth. And with a specially designed policy, you're going to see 4 to 6% growth on your cash that sits in the policy, and you'll be able to access those funds tax-free at any point for any reason. So there's something that you need to understand, is there's always a cost to money. There's either interest that you're paying to use somebody else's money, or interest that you're missing out on if you're using your own money. If you're using your own money, you're missing out on the potential growth from investing it. Now, by using a cash value life insurance policy, you are able to access those funds by borrowing against that policy, and those funds will continue to grow inside the policy as if you had never touched it. I'm going to explain this concept using the idea of a debtor, a saver, and a wealth creator. Some of the best uses of the infinite banking policy is to divert some of your regular expenses into the policy, things that you might normally be paying cash for or borrowing money for. And the reason we do that is that every time you divert those regular expenses into the policy, you're kind of turning those into little personal wealth building blocks that put your money to work for you on a permanent basis. Let's go through the debtor, the saver, and the wealth creator so you can kind of understand where I'm coming from. So this graph, this is the debtor. What you see here is, let's assume this is the vehicle purchases throughout a person's lifetime, okay? So what a debtor does is they will go to a dealership and they'll buy a car and they'll take out a loan. It's this here. And then they'll pay that loan back as they use the car. And eventually they're going to end up paying that car off, and then they're going to buy another car. And so they go into debt again, and then they pay that off. This line represents where you started at. So he started off with no money, or maybe a little bit of a down payment, borrowed, paid it back, and then did the same thing again repeatedly throughout the course of his life. Let's say 30 years, okay? So we've got 5 cars that were bought and paid for here over the course of 30 years. You'll notice at the end of these 30 years, he's in the same place that he was at the beginning, back at zero. So those dollars that he spent on transportation did one job for him. They paid for his vehicle. That's all that it did. And it did that job well. We're not complaining about that. But it only served one purpose. We can do better than that. Now here we have the saver. And the saver feels like they're in a much better position than the debtor, because they're doing real well and they're saving up to buy their purchase. They're not giving their money away in interest to a lender. And so we see here, they start off at zero and they save up for their car, and then they buy their car, they pay cash. And then they start saving up for the next one, knowing that it's not going to last forever, and they buy their car. And they do the same thing over the course of 30 years. Save up, and then pay cash. And where did they end up at the end of that 30 years? They end up in the same place that they started. back at zero. Again, those dollars did one job. They paid for their transportation, and they did that job well. But we can do better. How can we do better? This is how. This is what the wealth creator does, using the infinite banking concept. The wealth creator ends up putting their money back to work in multiple ways, while it's still compounding and growing in a safe, tax-advantaged asset. And here's how they do it. First, just like the saver, they start saving their money, only they're not saving it by putting it into a checking or a savings account. They're putting it into a specially designed cash value life insurance policy. And so we can see that go up here. They're saving their money, and then they're ready to buy their car. And rather than paying cash for the car, what they do is they take out a loan against that cash value that's in the life insurance policy. So when we say they take out a loan against it, it means they're not withdrawing the money out of their life insurance policy. That money gets to stay in there, compounding at a 4 to 6% interest rate. And they can borrow against that cash value at any point in time for any reason, with no credit checks, no need to ask for anybody's approval. As long as there's cash value available in the policy, you can access it for whatever your personal needs are. Okay, so at this point, he's ready to buy his car. So what he does is he borrows against that cash value, and then he pays back. And then he borrows from it again for his next vehicle, and he pays it back. And you can see that this cash value that's in the policy continues to grow at a 4 to 6% rate. And it grows and it compounds and it keeps getting higher and higher. This is what a compound growth curve looks like. And so he borrows, pays it back, borrows and pays it back. This initial savings that he went through is key. He started at zero, and from there on, it only went up. Because of the guaranteed growth in these kinds of policies, it's guaranteed that he will never go below the amount of money that he's earned already in the policy. So at the end of 30 years, look where he's at now. While our debtor and our saver were down here, look at where he's at. Because he was using his infinite bank policy to borrow money against that cash value. He never had to pull that money out. He did pay interest. He did pay interest on the money that he borrowed. You pay that to the insurance company. But the insurance company is giving you money on the funds that still sat in the account that you never withdrew. And that's really what makes this all work. Now, the neat thing about this is we talk about having a specially designed high cash value life insurance policy. And the reason we say specially designed is because with a policy that's designed specifically for the infinite bank concept, you could actually have more access to cash than you've paid into the policy in premiums between years 3 and 6, really depending on how you fund it and your health rating.